We talked a lot about, over the past 24 hours, this change in the tenant mindset and how it's impacting all of us. And I think this next panel is a really good one. These are folks who are doing nothing but investing in the tenant experience. And it's changed. They're raising hundreds of millions of dollars, massively successful businesses, all reimagining what tenants care about. Again, it's not co-working, it's not just flexible space, it's an entirely new product type. And it's not just office, it's retail, it's industrial. And so pay attention, these are the folks who are changing the market, and they've got a lot to say. So Brad, do you want to kick us off, do some introductions?
Yeah, let's do it. Thanks everyone, thanks to the panelists, and thanks to all of you for joining us today. The title of this is called Disruption of Tenant Experience. I think a better term probably is an enabler of tenant experience, and we can dig into the nuances of what that really means. But before I introduce sort of the esteemed panelists, let me, I just want to talk a little bit more thematically about the evolution of tenant experience and some of the metrics that are backing this up. I think it's kind of a good news, bad news situation. The good news is that I think the proliferation of technology is really providing owner-operators with an unprecedented opportunity to engage with tenants and monetize tenants in new and interesting ways. The hardest part about technology adoption, and this is sort of made true in sort of the proliferation of social media over the last 15, 20 years, is convincing users of technology to essentially engage in new and different ways. That's the hardest thing to do. The good news in this situation is that your customers and your tenants already understand and already use technology in the ways that these guys are looking to essentially promote and proliferate. So there isn't sort of this roadblock to essentially convince your tenants to use technology differently. They're already doing it in their personal lives. They're just looking for ways to do it in their professional lives. So this is just an enabling situation. The bad news is that I think this proliferation of technology is giving tenants and their employees a whole host of information and options than ever before, and creating a lot of complexity around providing them technology at scale, giving them more immediate feedback loops, customization of requests, space utilization constraints, flexibility requirements. All these things are creating, I think, roadblocks for traditional owners to think about how they leverage that technology and deliver it in interesting ways. And if you don't have a clear opinion and view of how to do that, you're at risk at falling behind. The good thing is I think there's very clear examples in real estate of this already happening once before. The hospitality industry experienced this in two different ways. The first was essentially the advent of the OTAs, the Pricelines, the Expedias, the Travagos, the Kayaks. Essentially what those technologies did was bifurcate the end user from the asset. Billions of dollars of enterprise value were stripped away from hospitality assets by technology companies and created massive businesses on the backs of that technology. Priceline and their parent co, Booking Holdings, is a $100 billion market cap company. Expedia is a $20 billion market cap company. These are huge, huge examples of what happens when the real estate industry falls asleep at the wheel and essentially fails to partner with and engage technology in interesting ways. And I think the office space in particular right now is at that unique turning point where I think the owner-operators are now making those decisions as to whether or not to engage in technology in a thoughtful manner. The hospitality industry was too late. They created their own booking site, and I don't think anybody here has ever heard of it, and there's a reason for that. Airbnb, I think you can make an argument, is another good example of the hospitality industry falling asleep at the wheel, not recognizing technology, innovating in their space, and choosing, again, not to participate and having the repercussions felt many years later. I'll throw some just quick stats just to kind of put things in perspective. Some of the driving stats that are kind of creating this shift from towards tenant centricity. Average business life, I think, is one. Small businesses, the typical small business has a lifespan of only 4 years. Average lifespan of a Fortune 500 company has dropped from 60 years in the 1950s to about 15 years now. It's expected to be 12 years by 2027. The current average lifespan of a publicly traded company is only 10 years. Half of the S&P 500 companies will be replaced in the next 10 years. 21 traditional US retailers filed for bankruptcy in 2017. 7,000 stores closed in 2017. The average lease length continues to shrink, and updates to FASB and other international accounting standards are going to make shorter-term leases much more attractive towards the end of 2018 when those take effect. Obviously, the proliferation of flexible space, which we discussed yesterday. Flex space represents about 2% of total office space in major U.S. cities today. That stat yesterday that JLL has come up with, that could be anywhere upwards of 30% by 2030. CBRE studies have found that 65% of corporations expect substantial to moderate use of co-working space by 2020. 87% of CRE execs have been charged with increasing portfolio flexibility. And we talked again about this yesterday. This is good business. Creating better workplace environments actually drives profitability. 70% on average of US workers are considered to be not engaged at work. 2.5x more revenue for companies with engaged employees versus those with low engagement. Highly engaged employees are 87% less likely to leave a company compared to disengaged counterparts. I can go on and on about this. There's plenty of data here, and we can definitely follow up and discuss the impacts of that, and we can talk a little bit more here. But in terms of who's helping navigate this changing world and the complexities associated with it, I think the panelists here are great examples of entrepreneurs who recognize this shift happening very early on and are building large organizations to work with owner-operators like yourselves to meet these challenges head-on and create expanded opportunities for you and your tenants. So with that, I'll introduce the panel. You have Jamie from Industrious, Ryan from Convene, and Ross from up here, who's lucky enough to join us after having a little bit of
I sort of built up my stamina.
I'd also say I'm also lucky enough to have each one of these fine gentlemen as CEOs of portfolio companies for Fifth Wall as well. So I've had a lot of interaction and seen them sort of take the industry by storm firsthand. So with that, I want to dive into a couple questions. We're definitely going to leave some room at the end because I want the audience to have an opportunity to engage in this conversation as well. This is a question that I think is foundational. I get this question a lot, and I think a lot of people here probably have this question. Are you guys technology companies? Are you real estate companies? Are you both? And why does that matter? How do you kind of see yourselves? Because this is a group that I think looks at the evolution of the VC ecosystem and sees companies like yours, and they're confused as to sort of who you are and what you represent.
You want to go first or what?
I think we think of ourselves as, it's not a sexy term, but an outsourcing company. I mean, we go to businesses and we say, hand off the provisioning, finding, creating, managing your workplaces to us, and you're going to get a better workplace outcome for having done that. And that's a combination of 13, 14 different products, some of which are technology products. But it's scary when you're a fast-growing business because, it's easy to get caught up in what's the market going to pay for. Should we say we're a technology business? Should we say? And I think those of us who are really doing well in the industry are the ones who are saying, how do you actually deliver a better day at work? And everything you do on the product side moves backward from that. Some of it involves technology, some of it doesn't. But in the end, I think sort of outsourcing is, for better or worse, the clearest description of what the sort of industry type is.
Look, it's a great question. I mean, I would argue that every company today doesn't necessarily have to be a technology company, but they have to be technology competent. And so I would say that when describing our platform, we often say that we're technology enabled. We do have a software platform that we acquired. We're launching a technology product that we think can really help transform the human experience in an office building. But I wouldn't define us necessarily speaking as a technology company. We view the world very similar to Jamie, which is we really view ourselves as a operating platform that understands physically how to deliver a workplace experience in an office building or in a physical workplace. We understand how to service and deliver hospitality to that. And we understand the importance that technology plays in shaping that experience both physically as well as from a service and hospitality perspective. But we are investing heavily in technology. And really, I think it gets back to what Jamie is saying, which is at the core of everything the three of us are doing is customer centricity, right? And I think if you look at the underlying theme for this whole conference, it's really a shift in mindset around the customer. And I think whatever we do, we view ourselves as a customer-centric organization where no matter whether it's tech or physical, it's really about serving their needs.
And Ross, before you give an answer, I'd love for you to explain a little bit more about what your business is, just because you're based in the UK and a lot of participants here might not be familiar with Appear Here.
So our business is called Appear Here, and we're essentially Airbnb for retail. So we've got around 150,000 brands and retailers that use us, and we work with a lot of the guys, a lot of the landlords that were up on that list. And right now in London, Paris, and hopefully soon New York, we have more retail stores in occupation than any major retailer.
And then, so how do you think about your platform as it relates to being a real estate enabler and/or technology company?
Yeah, so I completely agree with what Ryan and Jamie said. Our focus is ultimately about the customer, and our mission is how do we make it possible for anyone with an idea from that brand and retail side to find space to make it happen. But ultimately, the biggest investment from our side is into our technology teams, into the data, into the understanding we're getting from the marketplace. But at the same time, we're sat with landlords in the room trying to figure out ultimately how do we create better places and how do we create better experiences for those customers and those brands and retailers on the other side.
Sure. And the technology, I think Silicon Valley refers to essentially what I think you're describing as a service, right? There's a software as a service component that revolutionized sort of VC the last 20 years, and now you're starting to see that software as a service start to infringe upon the built world. And you guys are essentially the first manifestation of office as a service, workplace as a service, retail as a service. Do you view that as sort of a launching pad to a whole host of other concepts and ideas? Is this just the start of that? Where do you guys see the evolution of as a service space in the real estate industry as it relates to technology?
I mean, I would say, and I'll jump in first, I think we're at the first at bat of the first inning of this shift. And I think what's driving that is if you think about a building, whether it's retail or office, as a marketplace with a captive audience, the ways that you could start to think about how to monetize that audience or as a service, that ecosystem, to some extent can become endless. And whether you do it yourself or through partnership, I think there's just a lot of ways, once you control that distribution channel and the relationships within that distribution channel, I think there's a lot of ways that you can start to think creatively around how you monetize that, whether it's the way that we are or the way that Appear Here is doing it. I think what's equally interesting, and we're seeing this now, is work-life balance is being replaced by work-life integration. And we're seeing a blending of asset classes. And I don't think we're too far off where you might see, and zoning will have to move, where you start to see multiple uses within the same infrastructure, where companies like Industrious and Convene start to bleed into other types of use case. And so that's something that we're keeping an eye on. If you look at a lot of the things that are happening within mall repositionings and redevelopments, you're really seeing those assets really become these very integrated mixed-use assets. And when you start to think about what our business models can mean in that broader sense, there's a lot of optionality for each of these platforms over time, as we continue to focus on some of the trends that are playing out.
I think for us, I sometimes have a little bit of discomfort trying to sort of opine on where things are going to go, just because we've gotten as many things wrong in the last 5 years as we've gotten them right. I do think for anyone in the audience who works in any part of real estate, it's at least helpful to say, so what? Okay, it's an as-a-service industry in a very clear sense. We deliver a workplace as a product that you can consume on demand, just in time, on a subscription basis. I mean, that is exactly what as-a-service is. So what? I mean, the reality is, probably the number one so what is that as industries move over to as-a-service, it is the dominant product. I mean, you just look in industry after industry, and people started outsourcing data storage, and adoption went from 2% to 98% in a 5 or 6 year period. Even like Microsoft, when they switched to having a subscription for Word, it beat every internal estimate of everyone moving over to that from buying the sort of piece of software. And so I think probably the single biggest takeaway is once you pass the better and if you did it yourself and I can consume this as a service, these tend to dominate, sort of whatever precedes it. And they do require, I guess the second so what would be they do require sharing economy components. The whole thing that powers this is that you're centralizing in the software world, something in a, sort of centrally and then delivering it on a subscription basis to people. In this case, the only way our industries work is because of the sharing components, and it requires aggregating a lot of supply. And that's what makes WeWork so scary, is I think no individual landlord is going to be able to say, you can sign a subscription for real estate, and you're going to pay $600 a head, and we're going to get you at 40 people, at 80 people, at 800 people, and when you shrink back down to 400. Because no one has that much supply. And for better or worse, if WeWork raises another $4 billion,
We're well on the way.
they're going to get there. And we just know how powerful that proposition is.
And so you bring up a good point, and I think WeWork's always sort of the outlier as it relates to sort of the impact that it can ultimately have. And I think a lot of people sitting in this room think about WeWork differently. They have opinions on whether or not they're worth $20 billion and soon to be $40 billion.
Right.
They have questions of whether or not they are clients and/or competitors. How do you, with WeWork's positioning, how do you sort of view your, Ryan and Jamie, your stance in the market? Obviously WeWork can't take this new 30% number that JLL is predicting. They can't take all that space. People always ask, oh, well, if you didn't invest in WeWork, then you missed the boat. Explain sort of the opportunity set that still exists in this evolving space.
Well, look, I think what Jamie says about the future, and we're starting to see it already, is this idea of real estate being consumed by employee as opposed to by square foot, right? And in a outsourced fashion, that's a very feasible thing. And if we've proven anything collectively on this stage or WeWork, is that is starting to become a more dominant way that the consumer wants to consume a real estate experience. The way that we view our platform is really as the landlord's response to, and it's not just to WeWork, it's really to the changing requirements of today's customers and today's tenants, which are really focused on I'd say 2 or 3 primary things. The first is flexibility. And so how do you offer flexibility in term and agility from a physical perspective to prospective tenants today? Because whether it ends up being 10% of the market or 30% of the market or 50% of the market, every landlord has to be thinking, how do I satisfy that changing need within the market? The second thing is around human experience in the building. And how do I use human experience and monetization through technology or enabled by technology to create a different type of human experience in the building? And what we do is, it's really going to be hard, I think, for landlords to do this on their own. Every landlord probably in this room today is making a buy decision, a build decision, or a partner decision. And for Convene, we want to be the partner of choice at scale. Because what we do is we absorb all of this complexity. Because I'll tell you, what Jamie does for a living, what we do for, this is not easy, this is hard work. And it's very complicated, and we're able to absorb that complexity and then deliver simplicity back to our landlord partners, and then ultimately back to the end users who are our collective customers. So it's shocking to me that the industry has allowed one player to get that big and powerful without a true number 2 in the space. To me, like if there's a conversation that should be happening within the industry, and Jamie and I were having this last night, there needs to be a number 2. Because it's dangerous for the market and it's actually not good for the end using customer if collectively there's not a number 2 platform that emerges to compete.
I think as far as our positioning vis-a-vis WeWork, I'm going to say this quickly because it's going to make me sound like a jerk, but we wipe the floor with them in every market we're in when we go head-to-head with them over and over again for years now. On occupancy, on price, et cetera. So I would start by saying this is not an Uber and Lyft sort of completely indistinguishable product situation. And the reason for that, I think, is we're really committed to saying we are going to be the experts at delivering a great day at work. We are going to be better than anyone else at knowing what drives workplace productivity, workplace engagement, workplace happiness. Every investment we make is going to be with that in mind. Everything we do for our customers with that in mind. And for better or worse, very big company has to substantiate or sort of live up to a very large valuation. That's not what they're out there trying to do. They're trying to do 700 different things. They're trying to be the application of sharing economy dynamics to space writ large, retail, residential, which is probably a great business. It just means when you walk in the door to McKinsey or Airbus or Johnson & Johnson and they say, I'm freaking out because Google and Facebook keep getting the best people from every business school, and I got to figure out how to be able to say, I can deliver that great workplace experience. Can you help me? We're just able to deliver on that promise, I think, at a just definitively superior level.
Sure. So I think in Office, I think WeWork and your companies have created an entirely new business model that I think is additive to the ecosystem. I think, Ross, you're faced with a different challenge. You're faced with sort of an existential threat to sort of the retail marketplace. How do you view your company in terms of helping the retail sort of economy evolve to where it was prior, consisting of the same, 30 some odd large corporate scaled tenants to one now that consists of thousands of digitally native brands and experiential retail? How do you view your company as bringing retail into a new realm?
Well, I think first of all, what's interesting when we're talking about, just quickly going back to the last question with the office space, is, because I think it's got a parallel with retail, is you saw these sort of big box retailers that were the exact same, that had the same branding, the same style, the same product, roll out and go across the country. And now you're in a phase where people are a little bit like, do you know what, I want something different. I want things that are niche, that are unique, that represent who I am. And I think we've got to be careful, and landlords have to be careful on the office side, that they don't make the same mistakes that were made in retail, where suddenly every single office and every single street has the same design and the same slogans on the wall. So moving on to retail, I think what's interesting here is that you've got huge, big retailers that are obviously dying, that are shutting down shops. But I think what the most interesting thing for us is that we've got a huge supply constraint. So right now in London, less than 11% of our demand could be fulfilled by our supply if we booked out every single store. And last year we launched more shops than every single broker added together. And we, as I said earlier, we'd be the biggest occupier in retail in London and Paris. So I think what's exciting there for us is that everyone talks about retail dying, and I think it's being sort of grossly exaggerated. And actually, a lot of retail is just crap, and a lot of these big stores are rubbish, and you wouldn't want to go into them, and you wouldn't want to buy from them. And I think many people here, if I said, here's a few $1,000s, go into a department store and find something you'd like, they'd struggle. So I think what we're trying to do is help all of these small little brands find space to bring their ideas to life. And what's exciting there is by building this marketplace, we've got huge amounts of demand that we're connecting to the landlord and allowing them still to be in charge, them still to do the bookings, and them still to manage the entire process. But rather than one big retailer taking every store, you're seeing thousands of interesting retailers popping up, disappearing, and keeping people engaged.
Yeah, and I find sort of you've got this unique inflection point where retail is sort of, to your point, evolving, and data's sort of evolved to the point where now you can actually use that proliferation of data to help you make better decisions and cater that retail experience to even like the specific area that you're ultimately focused on. Like malls, which I think traditionally were built as community centers and eventually devolved based on essentially providing this homogenous experience, are now looking to essentially look at the data that they can gather from the community that they serve and actually give them the retail experiences that suit their needs specifically. Something that I don't think any retailer has been able to really do well before. How do you think about the sort of data and at your company and using that to make better decisions for your landlord tenants?
The data is really interesting. So first of all, we're using data to try and help landlords predict the type of buildings they should be building and bringing on the marketplace. I think the other thing that's interesting when we talk about space as a service and sort of all this stuff today is one big fundamental shift is that landlords are really focusing on the end user, i.e. the customer, the person walking down the street, the audience, more than ever before. And I think the idea of real estate has always been sort of location, 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 i.e. the audience is just going to be there. And what we're seeing with places like Fifth Avenue and in London, some of the key streets, is that the audience is just disappearing, the brands are underperforming, and the shops are shutting down. And what's interesting there is suddenly the idea that the audience is just going to always be there has sort of popped, and you're sat there going, hang on a minute, what can we do as a real estate owner to keep this street interesting, to bring content and keep the audience engaged? And why I mention that story is when you then look at our data, you can start to look at not only the space you should be bringing on the platform, but also the type of brands that will attract other tenants, the type of brands that are driving footfall, the type of brands that might pay less in rent or more in rent, but be able to counter that with the effect that they have on the retailers next door or the office or so on. So I think all of that starts to focus the landlord a little bit more on what they can do to build the most interesting customer base, i.e. footfall people, that will attract all the different tenants, whether that be office, residential, or retail, into their place.
And Ryan, Jamie, what about you guys as it relates to sort of leveraging data in new and interesting ways?
I mean, I think for us, the data drives ways that we can better anticipate or deliver an experience to our customers. So we recently acquired a workplace analytics company called Beco, which was based out of Boston. And what happens is Beco's sensor infrastructure ties into our mobile application, and what we're able to see in real time is how the space is actually being utilized. And it allows us actually, you know, on most of our favorite mobile apps like Uber and Lyft, there's that little blue dot that shows you where you are. Well, that doesn't exist in an office building. But with the company that we acquired, Beco, we're actually able to create a blue dot in a building. And so as we think about better delivering a human experience, and whether that's, hey, I'm on the meeting room on X floor and I need catering delivered to me, or we have a community event on XYZ, is there availability, did enough people show up? We're really starting to be able to use that data to better deliver human experience to our customers. It's also changing the way that we design physical space. And so by being able to see how our workplace customers and our meeting and amenity customers are actually physically using our spaces, that data set is going back in real time to our architecture, design, and product organization. And we're refining our product strategy, both physically and digitally, based on the analytics that we're seeing in the way that people are actually interacting with the space. And you know, it's amazing what we've seen. You know, we've got companies represented from Fortune 1000 to startup across every industry. And it's really interesting to see the different behaviors of how those industries and those types of companies are actually consuming and using the space and the services within our footprint.
To me, there's kind of three categories of data that really matter in our industry, and I suspect maybe in sort of real estate as it becomes more customer-centric more broadly. The number one is space usage data. That's table stakes. Our business is very sensitive to small sort of gradations of difference in density, in how many meeting rooms there are. You really have to understand how people use space. The second is on site selection, and this is something that's, you know, for a business like ours is really helpful, is we know where everybody's commuting from all of our customers across the country. We have 10,000 applications when we, you know, once we get to a few units in a city, and it enables you to, in a much more textured way, say, what does it mean to be on this corner versus that corner? What type of customer wants this or that? And, you know, ultimately, I kind of feel like I would hope to share that data with the real estate industry at some point, because it's like, it's valuable for us, but it's probably very valuable data in general. The final kind of data, and this is the one that I think very few people track, and it's the most important, is data around workplace happiness, workplace engagement. And this is where a lot of landlords, when they try to nudge into our industry or think they want to do more flexible leasing, miss the point, is they think it's all about delivering a flexible product at a certain square footage per person. And in the end, to Johnson & Johnson or whoever else, it's about, are you actually delivering a better day at work for my employees? And you have to show them. You have to say, we surveyed your employees on the day they walked into work, when you first moved into Industrious, and now a year later, here's all the metrics on productivity, happiness, engagement, et cetera. And if you deliver on that, that's actually the data that I think drives customer loyalty.
That's the holy grail.
Yeah.
That's the NPS. I mean, you guys use NPS as well, right? And so, I mean, we're super focused on that same metric, but it's interesting, and you know, I was talking to the team at VTS about this. There is no, most landlords don't track an NPS score.
Can you just explain to the audience the Net Promoter
So
Score?
it's a Net Promoter Score, and it's really simple. It's asking you pretty much one fundamental question, which is, would you refer this product or service to a friend, really, at the end of the day? And it's a very simple, we run a five-question survey. But it's the most important metric for us from an operations perspective, because what that's telling us is, are we delivering on the promise we've made to our customer around the experience? And now I think Jamie's even taking that to another level, which is starting to think about, how do I do pulse surveys around employee engagement in a more active way? And I think that's something that, I think as you start to look forward, is something that we're very focused on. And I wouldn't be surprised if that's something that, from a landlord perspective, you're going to want to start to focus on, is how do I actually start to measure engagement with the building, the experience, or the place that we're ultimately creating?
Yeah.
I also think there's one final thing, a big piece is what you just mentioned, Ryan, on the customer and how they're finding the landlord. But another interesting thing we're getting to is, if you think about the way that real estate's currently valued, the reason why businesses like WeWork, et cetera, are also able to move so quickly is because they're taking on the long-term lease, even though the customers change. There's sort of this divide in the way the landlord and sort of financiers value the real estate versus where the customer is at. And WeWork's got this great ability to sit as a band-aid between that. And I think the more data we get on understanding how much demand's truly out there, what they're willing to pay, what your average occupancy is from lots of different tenants, what you then get to is a point where you can create data that's not only valuable, but so trustworthy that the industry can start to look at how they value real estate in a different way, if that makes sense.
And I think that's a really important question for all of us. And I think the biggest challenge that we oftentimes face is, to me, from a deal structure perspective, the right deal structure is a joint venture or some sort of structure between us as operating platform and landlord. And I think the challenge that we've had in executing that gets back to capital markets and how the capital markets are ultimately valuing real estate. And I think there's a massive disconnect that exists today between what the customer wants and the way that they want to actually purchase a real estate experience today versus the way that the capital markets have historically valued assets, which is long-term credit against long-term finance at a cap rate. And other industries have had to figure, other asset classes have obviously had to figure this out. And this has been a big discussion that we've been having with our big landlord partners is, how can we be working together to really come up with the right valuation metric around how, if 30% of the industry is going to be flexible and amenitized, where experiences are bought by the second, the hour, the month, well, what are the valuation implications of that? And does that actually increase asset value and increase cash flow yields, or does that subtract from that? And I think that's something that just the industry and us as partners in that, and maybe part of it is sharing data, can really help to start to push that conversation forward. Because I think that that's really a major bottleneck to the industry and the ability to actually respond is because of a lack of movement and understanding within the capital markets, both debt and equity.
I should note that they are vigorously waving the Q&A.
Oh, there it is.
Sorry. it's enthusiastic.
Shows how good of a,
Very
of a
enthusiastic.
moderator I am. Yeah. They're eventually just going to cut off the mic. All right, with that, we'll definitely take some Q&A. So feel free to raise your hand.
Set up your operations in, if you will, and the ideal size, and then what's your business model in terms of revenue sharing, and how does that work? And then who markets this? Because now it's an end user marketing as compared to my local brokers marketing my product to mostly local brokers and tenant reps.
The minimum size would be, let's say, 16,000 square feet, but really ideally, we'd like it to be, let's say, 25 or so. And we have units now that we're opening that are 150,000. Now, that's, let's say 50,000 square feet of co-working for teams of 20 and below, and 100,000 square feet of, we call them canvas suites for teams of 20 to 200. And we do two types of business models. One, we still sign 2 traditional leases, arm's length leases a month, but we cap it at that. And everything else we do is under a management arrangement with landlords where there's we take a percentage of revenue as a management fee and a percentage of profit over a sort of market rent hurdle, and all the rest goes to the landlord. And if we're doing our job right, the landlord should make significantly more than market rents. Let's say 35% more than market rents in good years, and maybe 10% below market rent in bad years. But hopefully, there's more good years than bad years. It should work out to be much better than a fixed rate lease. and we do the marketing. So for better or worse, 8% of our demand right now comes through brokers, meaning we're the ones out in the world developing the relationships with CFOs, heads of workplace, doing all the digital marketing for smaller users. It might change over time. We would love, people think we want to stay away from it. We would love to build a stronger relationship with the broker community. But for the time being, it's 94% us or 93% us and 7% brokers.
I may have missed this, so apologies if it's a repetition, but how do you structure sort of the acquisition of the physical spaces? Are you signing a lease with landlords, or are landlords sort of providing the space and that's the partnership?
So, I mean, our model is very similar to Jamie, where we do sign leases, but more and more of our business is really being structured as more of a joint venture or some sort of profit share with building owner. So our average footprint's about 35 to 40,000 feet. A lot of the locations we're doing today are over 100,000 feet. And so we've actually been able to work alongside a landlord to actually anchor either new developments or assets that are going through transition. I think the difference between us and everybody else in the space is really, we don't recommend you do anything that doesn't actually increase the metrics in the Argus model. And we really view ourselves as a true strategic partner in not just how do you solve for flexibility, but how do you design the right experience within the building from an amenitization perspective as well. And so where we found that we add the most value is actually in assets that are going through transition. And whether it ends up being a lease or a joint venture, we're really agnostic to that. We just care about what our return on invested capital ultimately is as a company.
I think I misstated or understated my distaste for leases in our industry. Like, I think, I said we do 2 a month. I would love to move to 1 a month. I would love to move to 0. I think it's the wrong relationship for both sides.
Yes.
It's wrong for us. It's wrong for landlords. I think, WeWork has amassed an enormous amount of risk.
$18 billion of lease obligations.
Yeah, and it's just not the right arrangement. For like, just 2 things quickly. One, we're doing incredible things within our space. We're throwing whiskey tasting classes and sushi making classes, and we have beautiful hidden speakeasy rooms. And if we're in an arm's length lease with the landlord, we have no incentive to make any of that available to the whole building. So now you have something in your building that could be incredibly appealing to the long-term tenants in the building, that could materially alter your leasing velocity, your retention or lease renewal rates. And we can only really do that if we're in partnership with the landlord. And I think the really sort of, the worst part, maybe the sort of borderline dirty secret is, in the long run, if there's a horrible recession, and WeWork or us or anyone else, if a unit is losing money for 4 months, 5 months, 7 months, and they're putting money into the unit, at some point, WeWork is going to come to the landlord, or we are going to come to the landlord and say, I don't know what to do here. The unit is losing money. I can't put money in a unit that's hemorrhaging money for 3 years.
Look at retail.
And so ultimately, the landlord is sharing in the downside risk. Why in God's name would they
Not take the upside.
not take the upside in the good years? I mean, we have a location in Union Square where our underlying rent is $67 a square foot, and we charge $320 a square foot. That's a big delta, and I mean, I don't mind it, but we get to keep all the pie for the time being. I just think of the better arrangement as something is not leases. It's a management agreement.
And I think you would probably say the same thing. I think what we're all striving for is genuine alignment, right? Which is, at the end of the day, how are we working together to deliver the best possible experience to our collective customers, which will be smaller users that are leveraging stuff like Industrious or Convene, or the bigger tenants in the building. We've always opened our platform up to support the entire building. Yeah. It's never just been about Convene's 4 walls. It's always about how do we support the entire tenancy. And to Jamie's point, that's tough if you're not strategically aligned as a true, genuine, authentic partner with building owner.
What about in retail?
So in the retail space, for our business, we sign no leases. So we work with all the landlords. They list the property. We're averagely getting about an 80 to 90% rent increase, but as high as 500% in some locations. So to your point, what the landlords are doing with us is they are sharing that upside. And what we're realizing is that it makes more sense than signing a long-term lease, because the more you have changing, the more you have evolving in that store, not only are you increasing yields and rents, but also we're making the pricing more dynamic to which month, you know? November, December, you should be 300% up, whereas January might be 40, 50% down.
And I'd say, to add additional context, and we've got 15 seconds left, so I'll be quick. The most interesting use cases for using these unique and interesting use cases for a building is essentially using them as a sandbox with which to innovate and ingest and offer additional technology on top of what these guys are already offering. It infects the rest of the building, and we've seen that play out very successfully in a whole host of our strategic LP partners. So I would encourage everyone to view these guys as sort of the partner to help them think through not only technology to provide better service to their tenants, but also to educate them more on the use case of technology and how that can apply to their entire building, not just to the flexible workspace. And with that, I'd like to thank our panelists and thank all of you for participating.
Thank you, brother. It was a pleasure.
Okay, it's on, great. So thank you again, Ross, Ryan, Jamie, Brad. That was probably one of the most insightful panels that I've seen in a long time. A couple of key takeaways for me were this. One, these folks are agile, which means the same way that VTS builds software, we watch how things work, we collect feedback, and we change things. They're doing it to hard assets. There's no better example of customer centricity than that. They're watching where their customers are going, what they care about, and they're rebuilding space and repositioning it to make those customers happy. I mean, that's an unbelievable thing to see happen and come to reality. The second thing is this. It's not just office, it's retail. They are now taking more space in London than any other retailer. So while we hear it in the news every single day, Amazon's eating retail, in a lot of cases it is, there are still massive opportunities there. The third piece is this. They want to partner with you. You heard the lifts they're getting on rents compared to what you're charging in a traditional lease, and they're still saying, we're in this for the long run, be our partner in this.